Actually, Andreas touched upon the point of this model, actually, that that question, which was not very often raised during the last 30 years, even during the integration process, that whose interest or who is the major beneficiaries? Because all the rhetorics was in the last 30 years ago, how is it beneficial for the emerging, integrating successor countries? But it's failed to raise the issue, how beneficial is it for the West, who became the home country, the major investors in this region? So I will be touch upon this issue, and according to your recent request, I would structure my presentation on the achievement of the model. I would like to underpin your comparative idea in longer time perspective. Also, I would talk about whether is it still FDI dependent and some performance indicators. Very briefly, my research and policy alternative, which is we are in the time since the global financial crisis, which experiencing shift and challenges of this model, and political shift and also challenges and difficulties. I came to this issue actually just a few years after this article was published, sitting in ESPON meeting, European Union project meeting in Barcelona, and discussing the long-term scenarios for EU 2050 for the whole of Europe in territorial perspective, and debating with Italian and German colleagues. And the point was that all the discussion circled around only the north-south divide of Europe. And when we came to Eastern Europe, they considered, even the German colleagues and Mediterranean colleagues, Italian and Spanish, considered the whole region as a fully integrated and a kind of successful region in around 2011. So that's why I turned to actually Madison database and reading this very seminal works on dependent market economies. So you can see the GDP per capita gap between the Visegrad countries and the more underdeveloped Balkan, Southeastern European countries. And you can see that I identified three major modernization period, which mostly apply to all of the countries. But without going into details, what we can see that what the region, particularly the Visegrad countries, the most developed part, achieved is basically the same what we had at the beginning of the 20th centuries. And the deepest point is also interesting, the transformation crisis. So in relative terms, in comparison with the 12 most developed Western European countries, the largest shock and the biggest gap was not during the wars, world wars, not during the Great Crash, not even the recent financial crisis, but during the first decade of economic transformation. If we see in absolute terms, so mind the increasing gap, the gap is in nominal terms is increasing. So it's very ambitious to fill this gap, more than a double. But if you do it like European politicians, just turning the shorter time series, and they measure the convergence of since the European integration, and you can see that every country was most progressive and catching up most rapidly during the 90s, early 2000s. But what you can see even in the richer segment is a kind of flattening down and kind of stagnating the catching up and slowing down the catching up. So particularly the turning point is the economic financial crisis. Hungary was among the least successful performer, if you can see. I mean, the middle In the middle, not the most successful in terms of the most successful one, the Baltic states, Romania, surprisingly, Poland, and Slovakia lost the original dynamics in the early 2000s after the crisis. And despite being the most developed, Czech Republic and Slovenia stagnating. I mean, the catching up is slowed down. The framework conditions of this catching up is those kind of economic events and also political events which were much more turbulent. So the framework conditions for catching up was even more disadvantages during the last 150 years. We can see this kind of transformation, those periods which generated the largest transformation losses in Hungary, but still this transformation crisis is the biggest gap. If you look at the absolute terms, just to focusing in Hungary, what you can see, these columns are the aggregate GDP per decades. And you can see the last 30 decades, including the last decades of the communist period, is the least successful of the least 30 years. Yesterday, when I projected in this kind of policy meeting, it was astonishing, Minister. And if you look at the gross average annual growth rates, is even this last decades, due to the 2020 COVID, is not more successful and the same level of growth produced than the previous decades. So, and we can have no time, but obviously, beginning of the 20th century and the communist period, in terms of absolute term, was relatively successful in catching up at the expenses of many other deterioration. I like this dependent market capitalism model, and I'm most, but there are other theories which are worth to mentioning. The world system models, which argues that this region was always a semi-periphery. As we could see in the previous graphs, the gap was not much difference in the gap, what Andreas said previously, so it's not much progress. And what we can see, this period probably is less progressive, this last 30 years of transition, than the previous modernization period, particularly the early 20th century one. And also, one of the reasons of this, which also important to mention, this dependent market economies model focuses on capital, technology, trade dependencies, and very much based on this kind of investment trade nexus, and also related to the global value chain context as well. And the hierarchy and the integration of this country into this global value chain very disadvantageous, and we are on the lower segment of this hierarchy. And also subordinated financialization and dependent financialization, which was based on, other than FDI, mostly on banking capital, became very important as well. And also one is important to mention, the geoeconomics. Because East Central Europe is always considered as a kind of buffer zone, which was also a kind of shutter belt in between the German and Russian geopolitical interest, with China rising and showing interest towards the region, and the German and previously empires and German and served as a hinterland of German economy, and recently this is also the case. Okay, so this is the model which had very important consequences, as even Andreas mentioned it. If you compare with other models or the achievement of other emerging countries, even some of the post-communist ones like China, Vietnam mentioned, we can see and we can argue in certain extent, instead of also in GDP growth and certain achievement, is CEE in certain performance indicator falling behind its emerging market peers. One of the reasons is not just this unequal integration into the global value chain and independent mode of integration, but also this is the paradox that the region experiencing a constant capital shortage, still reliant on foreign external dependencies, so cannot perform autonomous growth. The whole model is externally managed. So despite this shortage of capital and reliance of foreign capital, there is a tremendous outflows of resources. Not just capital outflows, but also human resources, population outflows, and also demographic shocks. Performance, whether is it still FDI dependent economy? You can see the absolute dependencies like FDI stock to GDP, and you can see originally the pioneer countries, Czechs and Hungary, still performing well. Hungary is slightly decreased, above 60% of the GDP, but Estonia, Bulgaria, the latecomers catching up in terms of this. But I think it's one indicator. But in comparison with Germany, as in and even to Austria, the FDI dependency is clearly shown in this graph. But this is an important thing. So here you can see, in comparison with other world regions, Visegrad countries FDI to GDP ratio is the largest in the world, except some offshore financial centers, despite it slightly slowing down in the last decade. So the largest recipients of FDI, when one comes to the growth, what is the impact of this huge FDI inflow on growth, you can see that among the average or poorly performing regions, so there were exceptionally 7% annual growth, but on average is just below 5%. I show the figure. It's just the average in the long term is not more than 2% growth annually, if you consider. But the problem with this FDI model, why this political shift and turn took place recently, not just in Hungary, but even other countries, it's the huge fluctuation and unreliability of FDI. So in certain countries, the FDI inflows decreased rapidly, even outflows, but the underlying consequence is the profit outflows. Those countries here, you can see the net profit outflow started earlier in Hungary because it was due to this high score liberalization and earliest opening of the country. You can see here, in every country, the profit outflows indicated by green is increasing since the achievement, and it cannot be compensated by the blue, the EU funds. And also the remittances by the guest workers, which is due to the kind of outflows of human resources, refunded remittances, even cannot compensate together with EU funds with this kind of losses and other debt-related funds. Although the share within the industries, it's enormous. In case of Hungary, even this, since the crisis is increased, so industrial production, the foreign affiliates in Slovakia reaches 80%, but also 70% in Hungary. In export, 80% provided by multinational companies in Hungary. Although the value added is very high, but at the expenses of this, foreign value added generated by multinational companies, but the domestic value added is much less than expected at the beginning. So the supply chain is neglecting the domestic countries, and these kind of plants functioning as a kind of cathedrals of desert, not much spillover effect in terms of productivity, technology, etc., etc. You can see the German dominance. I wouldn't like to, also in the Hungarian economy is the largest FDI investors and the largest export partner as well. And what you can see coming to the end, actually, we had Visegrad countries covered database, and also recently with my colleagues, we measured the regional impact of FDI, but what we found, there is no significant impact on GDP growth, particularly not in the longer term. And what we found, domestic savings, which was a kind of key model in Asian countries, even in China. So the savings and later export based capital accumulation is the key for catching up. And even investment by governments and EU funds played larger role in GDP growth than in FDI. But the problem also, this FDI had a very strong crowding out effect, which even in the most attractive regions, most considered to be most developed regions from FDI point of view, is drying out other kind of endogenous factors, and even crowding out, like pulling out and draining out and pulling out and attracting the most skilled labor towards multinational companies. So it's a kind of struggle of the medium-sized company, particularly Mittelstand, which are shrinking in Hungary. So these are negative terms. So coming to the end, there is, so in macroeconomic impact is very negative. So this is a kind of explanation why you cannot see a strong impact on GDP or the catching up process. It's the dual economy is one of the kind of visible effect. And also the big problem, because we had in the turn of the century, we had within the empires, we had a kind of foreign induced capitalism, like Austrian and Czech capital played an important role. But after the time being, it shifted towards a kind of internal capital accumulation. So this is one of the biggest shortcomings of this model. It's failed to generate this kind of internal processes, and it's failed to shift, like the Singaporean model is a good example, how an Irish model, how to shift, how to use this kind of skills experience during this FDI-led model towards investing in your domestic economies. And the policy implications. Obviously, not just Hungarian government, but other governments realized that, particularly after the crisis, which was not considered to be an external shocks in Eastern European countries, because in certain macroeconomic indicators was much more stable in the banking sector, except FX mortgages, than in other Western counterparts. But because of vulnerability due to this external dependency, so the crisis was rather shown and revealed the vulnerability of this model rather than considered to be an external shock. So these countries realized, the politicians, that something wrong with the model, and the most modest Polish National Bank written that the end date and this model should be terminated because it served its original aim and goal, but there is not more potential to further rely on this model. So countries like Hungary, due to the needs for macroeconomic stabilization and due to the debt crisis generated by this financialization, started to select or distinguish between good or bad multinationals. And bad multinationals turn to be service sector-based multinationals, banks, foreign banks, but still keeping a strong relation with FDI-related manufacturing companies. This has an obvious reason, which even Andreas mentioned. The role of the banking sector is quite controversial here. This is a more banking-based financial system, but the role of the bank is not that decisive or strong or significant from the future development potential of the country than manufacturing sector.
Okay, Zoltán, I think I will have to slowly cut you off there because we're running out of time. Would you like to finish off?
Yeah, that's right. So this is a kind of interesting to discuss further. Why is distinguishing between bad or good multinationals, but also started to find alternate policies. So national developing, nurturing national champions, multinationals. But the big problems is in the top 500 largest companies in Eastern Europe, 60% are foreign owned. But in Hungary, the situation is even worse. 80% of the 500 largest Hungarian companies are multinationals. But Hungary has few strong regional multinationals, but we have a disadvantage in comparison with Czechs and Poland, which has much more bigger domestic companies.
Okay.
These are the alternatives. Whether the kind of balance can be shifted from the multinational companies' reliance towards the domestic economic.
Okay, thank you very much, Zoltán, for this discussion.
Thanks.